the past few days, we have witnessed some of the biggest bank failures in American history. As you may have heard, this is an alarming situation that has been all over the news. However, after receiving several messages, I realized that many of you might be new to the financial world. That's why I'm here today to help break down the complexity of this issue and provide you with a better understanding. In this video, I will cover some important topics, including how the banking reserve system works, why the Silicon Valley Bank failed, what's the role of the FDIC in this situation, and what's happening with Credit Suisse Bank. So first, we need to understand how the banks operate. You see, a bank's main goal is to generate profit because after all, a bank is a company just like any other. That means that when you deposit your hard-earned money into your bank account, it's not just sitting there even though you can check your balance. Banks are allowed to use some of these deposits to cover their expenses like paying their employees' salaries. They can also lend money to other clients, banks, and even the government. They can finance companies and so on. And in return for using your deposited funds, they pay you a very low interest rate. So every penny that you deposit into your checking or savings account is actually circulating in the economy. It's not just sitting there gathering dust, okay? However, there are rules and regulations that banks must follow to ensure that they have enough cash on hand to meet their customers' withdrawal demands. After all, people make withdrawals every day and the bank needs to have cash readily available to return to its customers. The size of these reserves depends on the bank's size and how much cash is deposited. Banks can keep their reserves in a couple of places. They can keep their money in vaults to quickly meet customers' withdrawal demands. They can also keep a portion with the Federal Reserve, which is the central bank, to cover emergencies and meet requirements. And they can also invest some of their reserves in financial assets like treasury bonds, which are considered safe investments. So keep this information in mind and will all make sense very soon. Now let's talk about the Silicon Valley Bank. This bank was founded in 1983 and it specialized in serving startups, especially in the technology sector, by providing them with borrowed money. Silicon Valley Bank became the 16th largest bank in the United States and also served clients in other countries like Germany, Canada, China, Denmark, India, and so on. As I mentioned, SVB's clients were mostly startups. With the economy in a tough situation, high interest rates, and a fear of recession, many of these companies began to withdraw a significant portion of their money from SVB to pay their bills. However, Silicon Valley, being a bank, didn't have all the money available because it was stored in their reserves and invested in treasury bonds. And that's where the problem started. So this is what happened. The bank lent $21 billion to the government by investing in treasury bonds, and in return, the government would pay them an interest rate of 1.79%. The deal was done. However, the American Central Bank continued to raise interest rates to fight inflation. And when interest rates rise, the government also has to pay more for the money it's borrowing. So the government was paying 1.79% to Silicon Valley Bank, but in a very short period, it began to pay other people and other banks an interest rate of about 4%. So Silicon Valley Bank found itself in a very complicated situation because their customers wanted their money back, but to sell the bonds and have access to the money, they would have to sell it at a lower price. Because think about it, why would an investor buy bonds with an interest rate of 1.79% when they can get ones with a higher interest rate for the same price? Exactly. So on March 8th, the Silicon Valley Bank reported a loss of $1.8 billion and began to break. But before Silicon Valley released this information, another bank called Silvergate filed for bankruptcy for a very similar reason. With Silvergate, clients also wanted to withdraw their money, and the bank also had to sell its investments, taking a loss and going bankrupt. So when on the next day, Silicon Valley had reported a loss of $1.8 billion. It was too much coincidence, and their clients began to panic. What a terrible timing, because if someone hears that a bank is going to fail, everyone will immediately withdraw their money, and it will worsen the situation because it will cause a run to the banks. And if this wasn't enough, the same story repeated itself in New York City with Signature Bank. There was no way around it. The FDIC had to step in to alleviate everyone's worry. And for those who don't know, the FDIC is that acronym that you see at the banks, but you never paid attention to, always ignored. It stands for Federal Deposit Insurance Corporation. This insurance was created because of, guess what? Bank runs. It was created to ensure bank clients that in the event a bank fails, they are insured up to $250,000 per account, per person, per institution. So check if your bank is insured by the FDIC to make sure that you are covered. However, regular people like you and me don't have $250,000 sitting in a checking account or a savings account. But remember, the clients of these banks were not ordinary customers like us. They were startups. $250,000 was nothing to them. Their balances surpassed that amount. Therefore, the FDIC announced that clients of Silicon Valley Bank and Signature Bank will receive their full deposits back. This measure was taken to try to ease the situation and make all of us feel more at ease. And are you thinking that the problem ended here? You're wrong. Just as investors were digesting all this chaos, a new bomb shook the financial market, and this time the bomb was one of the largest European banks, Credit Suisse. First of all, I want to make clear that Credit Suisse problems are not related to Silicon Valley Bank, even though it's a mega coincidence that all of this is happening in the same week. Second of all, Credit Suisse has been facing problems for a very long time. The bank has been dealing with many scandals such as frauds and money laundering, and their customers are not satisfied with these scandals within reason and have been withdrawing money from the bank and closing their accounts. So put all of this together, and it is expected that Credit Suisse will have a mega loss. But what actually shook the market was that Credit Suisse reached out to one of its main investors, asking them to inject money into the company, but the investor said that it would not help. The investor in this case is the Saudi National Bank, and according to its president, it will not help Credit Suisse because of a regulatory issue. If they injected too much money into the company, their investing stake would exceed 10%, and there are regulations that do not allow Saudis to have a larger stake than 10%. But today, at the time of recording this video, the Swiss National Bank said that it will help Credit Suisse and lend the money to the bank. So this was another example that in the financial market, it's all about timing. Of course, a lot can still happen because everything is very recent. Next week, we will find out whether the central bank will increase its interest rates or not, and we will see how that will affect the entire situation. But maybe right now, you might be asking if this is the right time for you to withdraw your money from the bank and if you should be panicking. First of all, calm down. I believe that widespread panic will not help anything. On the contrary, it will only make things worse. Second of all, it's always good to diversify your money, and that includes having bank accounts with different institutions for safety. So what's happening can serve as a warning for you to evaluate who you have an account with, whether your bank is trustworthy, if it's insured by the FDIC, and so on. And if you own a company, never leave more than what's insured, which is $250,000 in your bank account. If the type of business you have requires having that much money on hand, have different accounts with different institutions. And that's all for today. And don't forget that in the midst of every crisis lies great opportunities. While it's raining outside, there's always someone selling umbrella. Take care, and I will see you next time. Bye-bye.